Hey, what's up, my friend? So, in today's training, right, it's all about sniper trading entries. Kapew! Right? So, you'll discover 4 simple price action patterns, right? So, you can, better time your entries, predict market turning points, and overall improve your trading results. So, I don't waste any time. Let's get started. Number 1, the breakout with a build up, right? So, this is a entry technique, right, that helps you identify high probability breakout trades. And here's the thing to look for. Number 1, you want to have the market, right, to be in a range for at least 80 candles or more. And the reason is simple, because based on my observation, right, the longer a market range, the harder it breaks. So for example, let's say you compare a range one that is like this and another one that is like this. When the price breaks out, right, which of these two range market will lead to a stronger trend? If you ask me, it's this one over here. And the reason is quite simple actually. It's because when the market is in a range, the longer that it's in a range, more resting orders will accumulate above the highs of resistance and below the lows of support. Why is that? Simple, right? When the market is in a range, trader will look to buy low, sell high. Buy support, sell resistance. When you buy at support, the lows of support, where will you put your stop loss? Probably, below the lows of support. And if you think about this, right, if you are long at support, your stop loss is in essence a sell stop order. Make sense? So the longer the market is in a range, the more sell stop orders will accumulate at the lows of support. And likewise, when traders who are selling near the highs of the range at resistance, it will accumulate, right, a number of buy stop orders, right, from traders who are short. Their stop loss order is in essence, right, a buy stop order. So when the price breaks out of this range, this cluster of stop orders will be hit. And if you imagine if the price breaks out of resistance, it hits a cluster of buy stop order, that is buying pressure to push the price up higher. So this is why we look for the market to be in a range for at least 80 candles or more. Now you don't have to get too, anal about this, right? If the market is in 78 candles, 79, it's fine. I just leave a general guideline to use as 80 candles. The next thing you want to look for is for the 20 MA to support the price before the breakout. And what we are looking for is for the price to consolidate just before it breaks out like this. Like this, consolidate. Okay? And the reason we want this consolidation is for 2 reasons. Number 1, when it consolidates near the highs of resistance, this is a sign of strength. It tells you that buyers are willing to buy at these higher prices. That's 1. Number 2, you have a logical place to set your stop loss, because now your stop loss can just go, let's say, below the lows of this build up, maybe somewhere about here, distance below it, somewhere here. Compared to, let's say, the consolidation didn't form, it looks something like this, right? Let's say the market in a range, it breaks out. The nearest point where you can set your stop loss is below these lows of support, and it's usually pretty darn large. So when you have a build up that's being formed, when you have a consolidation, it offers you a more favorable risk to reward on your trade. So let me share with you a few examples about the breakout. So first one over here, okay, you can see that this market is $1 against the Chinese yuan. First and foremost, you want to see at least 80 candles from here, the start of the range, all the way towards the end. Like I've said, right, 80 is just a general guideline. If you have 75, 77, 78.69 whatsoever, it's fine. So how do you know there's 80 candles over here? So what you're looking for is, again, you can use a tool like this one over here on TradingView, pull it from left to right. You can see that at this point in time, you have about 86 bars on this chart so far, forming this range. Okay, so that meets our criteria. The second thing to look for is, remember, we are looking for a breakout with a build up. So this is where the build up has formed, okay? And the key thing to note is that you want the 20 MA to catch up with the lows of the build up, to signal to you that the market is getting ready to make a move. So just pull out the 20 MA. And at this point, some of you might be asking, oh, Rayner, should I use the 20 EMA or the SMA, the WMA? Honestly, doesn't matter. Concept is what matters. If you use EMA, SMA, whatever MA, it's not going to make much of a difference, alright? Well, in this case, I use an EMA, okay? But again, won't make much of a difference. And you can see over here, the price has, or rather, the 20 MA has caught up with the lows of the build-up. This tells you that the market is ready to make a move. So what you can do is simply to place a buy stop order above this highs, and your stop loss can now reference this swing low, right, to set your stop loss. Because imagine if without this build up, right, your stop loss will be referencing from this low over here, and it's very wide, and that doesn't offer a good risk to reward on the trade. Okay, so this is what a breakout with a build up looks like. So let's look at another variation. So for this variation, you can see that the build up formed, right, before resistance. For this one over here, euro dollar, just going back in time, you can see that over here we have this area of resistance somewhere about here. And this time around, the build up actually formed after the price has gapped above this area of resistance. So this is another variation to it. So here's the thing about technical analysis. As much as I can share with you so-called textbook examples, cherry pick examples, but when you are trading in the live markets, it's very important to understand the concepts that I'm teaching, because the examples that are going to unfold itself, maybe for your market, for your time frame, will be different. It's not going to be, exact picture perfect. So this is why it's important to understand the concept, and whatever variations that is being thrown at you, right, you can still grasp it, right? So in this case, you can see that in this case, right, the market broke out of resistance over here. Then it formed a build up at the highs or just above the highs of resistance. So if you think about this logically, what is the market telling you? From the looks of things, it's telling you that, hey, price has gap up higher, break out of resistance, and the price is now consolidating at the highs of resistance. It could hit higher, it could hit lower. It's anyone's guess. But the fact that it can still consolidate at the highs of resistance without breaking down below, it's a sign of strength, telling you that, hey, buyers are still willing to buy at these higher prices. So what can you do to trade this breakout? Again, same concept. You want to make sure that the build-up form is long enough. So pull out your 20 MA and make sure the 20 MA has caught up with the lows of the build-up. In this case, it did over here. At this point, touch the lows of this build-up, and it started to reverse. So at this point, you could place a buy stop order above this highs. Your stop loss can reference now below this lows, right, to set your stop loss. Okay, so this is another example of a breakout with a build-up, but a variation to this is that the market this time around has actually broke out of resistance first before, it forms a build-up. So one more example to take home this point. So another variation to this, right? So if you understand the concept so far, it's again looking for a range of at least 80 candles, waiting for a build-up to form at resistance or at support if you're looking to sell the market, and then let the 20 MA catch up with the lows of the build-up. So in this case, you can see again, price form a series of higher lows into resistance. 20 MA has caught up with the lows of this ascending triangle over here. So what does this tell you? Again, this is another sign of strength. It tells you that buyers, they are willing to buy at this higher prices. That's why you have this series of higher lows, higher low, higher low, higher low coming into resistance. So where can you enter a trade? You can set your order just above the highs of resistance somewhere here. Again, stop loss. Is there a logical place to set your stop loss? Well, looking from this setup, right, you can see that you can actually reference it now from this swing low to set your stop loss, maybe somewhere about here, because you have this build up, you have this higher lows that you can reference from to set your stop loss. Make sense? Okay, so this is what I mean by the breakout with a build up. And obviously, right, the opposite of a breakout with a build up is just simply a breakout without any build up, where it goes up like this breakout. Right, this is the type of breakout that I avoid because there's just no logical place to set your stop loss. So moving on, the first pullback. So here's the thing, right? Sometimes you are trading the breakout with a build up and you might miss the move. Maybe the market doesn't make any build up and it just go boom, right? It just breaks out of resistance. So what now? This is where you want to pay attention to the first pullback, because whenever the market breaks out, there is a high probability that it's going to make a pullback, right? It needs to rest, take a breather, pause, after you run 100 meters, you need to take a pause. Look for the first pullback, and the key thing to look for is that number one, what your first use allows you to catch a trend even if you miss the first wave of the first move. So what you want to look for is a breakout of resistance, a weak pullback. So a weak pullback simply means, right, that the range of the candles are nice and small, so very nice and tight. So it's not large, but just small range candles on a pullback. And the 20 MA has caught up with the price. So as the price makes a pullback, you want the 20 MA to to slope up higher and to catch up with the lows of the price. Kind of similar to the breakout with the build up that you've seen earlier. Okay, so let me share with you a few examples of the first pullback. So if you look at gold, okay, you can see over here at this point, price has broke out higher. Okay, and a mistake that many traders make, new traders, is that they're going to buy the breakout. They're going to buy this bullish move over here. Oh, Rayner, look how bullish this market is. It's going to the moon, right? It's time to buy. What? You're waiting on the sidelines? You're in moron, right? You have to be buying right now, Rayner. Well, that's me when I started trading, like, maybe 8-10 years ago. So, no, that's not a good idea. You don't want to be buying right now. And again, remember, I mentioned that if you were to chase breakout, if you were to buy breakout without a build up, there's no logical place to set your stop loss. If you look at this price structure, the nearest price structure you get is this possible previous resistance that could become support. So your stop loss might be somewhere about here. Pretty darn large. So remember, we said that if the price breaks out and you miss the move, don't worry. Wait for the first pullback. Right, the first pullback. And what you want to look for is for the price to retrace, right, with small bodied candles. So in this case, we have a retracement over here. Okay, and let the 20 MA be your guide, because here's the thing, right? When the price pulls back, like say at this point over here, it's starting to pull back. You're wondering, man, is it time to enter the trade? So this is where the 20 MA is so useful. Let the 20 MA catch up with the price first. So at this point, you can see that the 20 MA is still a distance away from this this price point, this low of this candle. So give it some time, give it a few days for the 20 MA to catch up with price. So as you can see over here, when the 20 MA finally on this this bar, it has caught up with the lows of this build up of the lows of the pullback. This is where you're ready to place an order to enter this market. And again, very simple. Buy stop order can just go above this highs. Logical place to set your stop loss can now be below this swing low over here. So can you see a difference between chasing the market and waiting for the market to come to you? Okay, so this is what I mean by the first pullback. So even though you have missed the first move, don't worry. Opportunities can still come around. Okay, so in this case, this is where we got the first pullback. Price eventually broke out of this highs. Then you can just reference either this swing low as your stop loss, or if you're more conservative, even this low. Next example, Aussie Canadian, same thing. Okay, same. I'm going to walk you through the psychology of traders who are looking at this market. So over here, boom, right? Price breaks out. And what traders will do is they wait for a pullback, possibly to previous resistance that could act as support. Sometimes the market does retest, sometimes it doesn't. So what now? Remember, the first pullback. What you're looking for is a wick pullback, small range candles, and let the 20 MA be your guide. So you pull out the 20 MA. 20 MA has to touch the lows of the pullback first. So in this case, it has touched it over here. Great. It has touched the lows of the pullback. And if you look at the range of these candles, it's very nice and small, very nice and tight. That's good, because it tells you that there isn't any strong selling pressure, controlling the market and about to push the price lower. If you look at this, right, this is strong selling pressure, strong selling pressure, strong selling pressure. Look at the range of all these bearish candles. And you compare that to this one over here. Do you see the difference? One is where the sellers are in control. The other one, buyers and sellers, they are in equilibrium. No one's in control. And you want to see this type of price action where the candles, the range are small. So now, 20 MA has caught up with the price. Great, what now? So again, you can just go with a buy stop order above this highs. Setting stop loss can just go 1 ATR below this lows. Give it some buffer, maybe somewhere here. And that's how you trade the first pullback. Make sense? Next one. And by the way, right, if you are enjoying this video so far, smash the thumbs up button. If you don't, then hit the subscribe button. So next one, the false break price pattern, right? So this is simply a reversal price pattern, right, to profit from losing traders. I'll explain more later. What you're looking for is a strong move into support or a strong move into resistance, depending on your trade direction. So let's say we are looking for a strong move into support, right? You want the price to trade below the low of support and close bullishly above it. Vice versa for short trade. So in other words, what you're looking for is for the price to come aggressively, bearishly into support, take out the previous low of support, okay, and then close bullishly back above it. This is what I call a false break, because this is a false breakout of these lows. So an example to illustrate my point, dollar against the, sorry, not this one, pound Canadian. Okay, so let's look at pound Canadian. So this one is the strong move, right, into resistance. You can see how bullish this move is. Let me just zoom in the chart. And you can feel, right, the bullishness. Price made a strong bullish move into resistance, taking out this highs. Next candle, we have a sudden reversal. So earlier I mentioned, right, is a reversal pattern, right, to profit from losing traders. And I want to ask you this question. Who are the losing traders? Can you think of an answer? And the answer is quite simple. The losing traders are those people who bought the highs of this breakout. So can you see that when the price breaks above the highs of this breakout, do you want to be buying? Earlier we talked about the breakout with a build-up. Did any build-up form before it broke out? Didn't, right? It just made a strong bullish parabolic move into this area of resistance and then reverse lower. So those traders who bought the breakout of these highs, or maybe when it closes above here, they are now in the red because the market made a 180-degree reversal against them. So this is why I said don't chase breakout. Don't buy breakout without a build-up. This could happen to you. How do you trade this? Very simple. Next candle open, you can go short. Okay, next candle open, you can go short. Stop loss, right, can just go a distance above this highs somewhere here. This is what we call a false break. In essence, a false breakout. Another example, Aussie against the New Zealand. How about a weekly time frame? Same concept over here. Okay, so this one I want to share with you. It's something interesting, right? So Aussie New Zealand, if you look back, okay, we had a false break previously at this area of resistance, right? Previous support that could act as resistance once, twice, and came back here over here. Over here is a false break. All right, price got rejected at the highs of this resistance. But as much as possible that, this is a setup that you could trade. I want you to know that trading isn't like, you enter, set your stop loss, you set your target, boom, market straight away give you profits. Doesn't work that way, because if you look at it, market can consolidate, play with your feelings, make you cut your loss prematurely and before finally reaching your target. For example, this one over here, it gives you a false break, consolidate here, goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down, and maybe finally, right, reaching your target at depending where you set your target. Maybe at this lows over here, perhaps you could set your target. One possibility is at this lows over here. That could be one possibility. But you can see that the market didn't just went smoothly in your direction. It played with your feelings, right? Goes up, goes down, goes up, goes down. So although today's topic is just about trading entries, I want you to know the importance of trade management. How are you going to manage your trade if the market moves against you? How are you going to manage your trade if the market moves in your favor? So this is a very important topic that I can't cover in today's video. If not, it'll be a few hours long. But you have to think deeply about this. And another one over here, again, this market isn't making it easy for traders. You have a false break at this highs of resistance over here, a false break. Again, goes up, goes down, goes up, goes down. Now it goes up again. It's playing with your feelings, right? Man, should I take profits, or should I hold on to my trade, or should I follow my trend and let it hit my first target at, let's say, maybe at this swing high, where it could become a previous swing high, could become support. These are questions that you have to think about. I can just show you the entry, sniper trading entries, but it doesn't mean that it's going to be easy as 1, 2, 3, where it's going to reach your target quickly, right? Because it's going to toy with your feelings, it's going to mess with your head, and these are questions, right? These are things that you have to be aware of and plan for it ahead of time. Okay, so this is another example of the false break. And one more is the dollar against the Mexican, just to share with you. So in this case, this false break is basically against the trend, but still is a valid setup. So as you can see, trend is towards the upside. Price had a strong sell-off or a strong pullback. Then it staged another rally, right, and retest the previous highs over here, this highs. Then it get rejected and close near the lows of the day. This is a valid false break. Can look to sell. Stop loss can go 180 above this highs, and your possible first target could be somewhere about here. Okay, and again, in this case, well, it depends. Depend on how you set your targets. If you set it at the smack at this extreme lows, probably won't get filled. Market, in fact, retrace against you, toy with your feeling, give you some hope, toy with your feeling, give you some hope, toy with your feeling, and then finally collapse lower and then hit your target over here. So again, right, I just want to bring you to the reality of trading. Okay, no fancy pensive stuff over here. And next one, okay, that's the third technique, the false break price action pattern. And finally, the last one is what I call the break of structure. So the break of structure is a pattern, right, that allows you to catch the turn of a new trend with low risk. I'll explain why later. So the key thing to look for is, number one, a downtrend approaching support area. So the market is in downtrend, lower high and lower low like this. Then let's say this line over here is the key area of support, right? That this key area of support is can be seen on the higher time frame. Okay, then what you're looking for is a break of structure. So the current market structure now is lower high, lower high, lower high, lower high, and lower low. So what you're looking for is a new series of higher high and higher low, something like this. Goes up higher, pulls back, and then breaks out higher. So at this point, you now have a higher high and higher low. Make sense? So this is what we're looking for. And the key thing again, right, is that you want the market, right, to come into key price structure that can be seen on the higher time frame. So for example, let's say you're looking at a break of structure on the 4-hour time frame. The price has to come into support on a higher time frame or resistance on a higher time frame. So let me explain what this means, right? It might sound confusing, but this is key because you want to trade off strong levels on your chart to increase the odds, right, that the market will reverse. First one over here, dollar against the Norwegian kroner. Okay, so you can see over here, I think the weekly time frame, price has come into this key area of previous resistance that could act as support over here. Okay, and the break of structure here can be seen on the lower time frame, the 8-hour time frame. So remember this black line. You know what, let me just split up my chart so you can see what I'm seeing. Okay, so on the 8-hour time frame, this is, let's say this is the weekly, then this one here will be the 8-hour time frame. This point over here is in essence, right, this portion here. So if you just zoom out and look towards the left, right, you'll see that this is the area of previous resistance that could act as support. So the break of structure is pretty much as what I said earlier, right? A series of higher high and higher low. So if I just to keep things constant, this will be the black line that you've seen on the weekly time frame. So what you're looking for is at this point, you have a series of lower high and lower low. Lower high, lower high, lower high, lower high, and lower low. So you don't want, at this point, you don't want to be buying just yet because price has not formed a new break of structure. So what you want to see is a series of higher high and higher low. So at this point, you have a higher high, right? And it pulls back. This is key, right? Look at this pullback. It's very weak. Let me just, you can see over here, the range of the candles is nice and small. And this is what you want to see because it tells you that the sellers are not in control. Okay, so you have a higher high, higher low. So when the price breaks above these highs, you will go long. And again, I'm not just blindly trading this break of structure. It's because big picture wise, you have seen that on the weekly time frame, okay, which is this one over here. This should be the weekly time frame. Okay, this weekly time frame over here, okay, it's in an uptrend, and it's in an uptrend, and also it's coming into this key price structure over here, where previous resistance that could act as support. Only then, right, on this lower time frame, the 8-hour time frame, do we trade the break of structure. So I'm just going to find this break of structure over here again, right? Only then do we trade this break of structure. Does it make sense? So I'm not trading this pattern blindly. There is the context of the market to consider as well. So another example, right? Pound yen, right? Let me just go to pound yen. Let me just make the chart big again. Okay, so pound yen daily time frame. I want you to see is this portion here. Okay, at this point, price has come into this previous support, right? That could act as resistance. Previous support, act as resistance, and resistance. So for those of you who trade off the daily time frame, there might be setup that you could trade this price rejection over here. Okay, but that's not the only setup to trade, because again, if you go down to a lower time frame, like let's say the 8-hour time frame, the 4-hour time frame, I'm going to share with you what you will see. So on the daily time frame, let me just find that chart over here. Okay, so over here at this point is equivalent to this juncture. This over here is equivalent to this portion here. Okay, so at this point in time, right, you can see that if you just zoom out, market seems to be in an uptrend, right? Series of higher highs and higher lows, higher lows, higher lows, higher lows, higher lows, right? But you know that the big picture wise on the daily time frame, the market is actually in a downtrend, as you've seen earlier, and it's at this area of value, this price structure, this area of resistance. So at this point in time, right, when you're looking at this 4-hour time frame, you are waiting for clues from the market that this market is about to reverse lower. So what are some clues to look for? Again, one example is the break of structure, a series of lower highs and lower low. At this point, you have a lower high, okay, and when the price breaks below this low, you now have a lower high and lower low. This is what we call a break of structure. So you can go short when the price breaks below this low. Stop loss can just go 1 ATR above this high. It's just a buffer above it. Okay, so this is what I call the break of structure. So one more example just to hammer home this concept called the break of structure. How about oil? Okay, so just go look at the big chart, the big picture. Oil, you can see over here. Again, daily time frame, price has come into this area of resistance that you see over here. Okay, you can see that you look left, right? This is an area of resistance. Tested once, twice, thrice, and it's back here for a 4th time. And again, if you go down to a lower time frame, I'm just going to split the chart up. This one, 4-hour time frame, it's going to look like this. Okay, the 4-hour time frame. So over here, this portion here, right, this area of support, right, is what it looks like on the 4-hour time frame. Okay, and the break of structure in this case occurred somewhere near here. When you look at this, the price made a series of higher high and higher low. At this area of resistance, you now have a series of higher low, higher low. And when the price breaks above these highs, right, it's a valid setup to go long. There is a break of structure. In fact, this is very similar to the breakout with a build-up that you have learned earlier. Right, it's another variation of it, basically stacking concepts on top of concepts. So at this point, you can see over here, this is the area of resistance, and this is support, right? And this is the same juncture that you saw earlier on the daily time frame. This is coming to a higher time frame support. And over here, you have this build-up that's being formed at resistance. Okay, so eventually when the price breaks above this highs, you can look to get long. Stop loss can now go 1 ATR below this lows somewhere here. But in this case, I think this trade didn't went too well, went in your favor, and then pretty much reversed and collapsed. So again, that's the reality of trading. Nothing goes in your favor all the time. So with that said, right, let's move on, right? We talked quite a bit on the break of structure. Next thing I want to talk about is context matter. So yes, I spent a lot of time talking about entries, right? The false break, the first pullback, yada yada. But you have to understand that the context matters. So what do I mean by this? Let's say you know a bull flag. I'm sure. Let me just explain what is a bull flag. So bull flag looks something like this. Okay, price pulls back, from a flag pattern, breaks out. This is a bullish sign. But let me ask you, do you want to be trading a bull flag in a downtrend or a bull flag in an uptrend? So you can see that, let's say for example, a bull flag that's being formed like this. Price is in a downtrend, then it forms a bull flag like this. Okay, and you compare that with a bull flag that's formed at this point in time. Both of them are flag pattern. But which one do you think has a higher probability of it working out? This one over here or this one over here? So this is what I mean by context matters. Okay, so first and foremost, right, the key thing to look for is to trade in the direction of the trend, right? Could be the current time frame that you're trading or the higher time frame trend. Especially for example, you saw earlier the break of structure. It might seem that it is counter trend trading, but you're actually trading in the direction of the trend, the higher time frame trend. I don't trade the break of structure if I'm trading against the higher time frame trend, because it doesn't make sense, because the odds of it working out is low. I only trade the break of structure if I'm trading aligned with the higher time frame trend. So the first thing is to really, right, whatever price patterns that you're trading, you want to trade in the direction of the trend as much as possible, if possible. Okay, for advanced trader, if you want to take counter trend trade, that's fine. But if you're new to trading, if you want to improve your odds, trade in the direction of the trend. Number 2, don't trade far from an area of value. Let me explain what this means. So let's say, for example, if you know that the market is, let's say, in a trend channel like this, okay, and clearly you want to buy since this is in an uptrend. But from the looks of things, right, do you want to be buying at this point? Let's call this A, or do you want to be buying at this point? Let's call it B. I hope you said B, and that's because B is an area of value for buyers. If you buy at A, yes, you're trading with the trend, but there's a good chance this market could retrace and pull back. And if your stop loss is too tight, you will get stopped out on the pullback. So don't trade far away from an area of value. A is far from an area of value. No go. You want to trade near B because it's near an area of value. So just a quick example to illustrate this point. So if you look at euro dollar, I'm just going to zoom back out in time this chart, remove some lines. You can see that this area of value somewhere about here. Okay. Just I'll say I'll draw this this trend line, something like this over here. So the key thing to note, right, is that you can see that this is actually respecting a trend channel over here. Possibly you'll draw this. And when the price breaks below this lows over here, yes, the overall trend is in a downtrend. When the price breaks below these lows, I hope you're not trying to sell over here. Yes, but Rayner, I'm trading with the trend. You said trade with the trend. Yes, I said trade with the trend, but at the same time, you also want to pay attention to the area of value. If you're looking to sell in this market condition, where is the area of value? Okay, just look left, zoom out. Area of value possibly is at this area over here. You want to look for selling opportunities at this this upper boundary of this trend channel, not the lower boundary, not here. Here, okay? Don't trade far away from an area of value. Even though you might be trading with the trend, if you trade far from an area of value, market is about to make a pullback. There's a good chance it could pull back. When it does occur, you'll get stopped out. So that's the second one. And finally, higher time frame price structure confluence. So what do I mean by this? So this can really enhance the odds of your trade if you are trading where higher time frame, where you're trading, right, where there's a confluence of the higher time frame support resistance. For example, let me just share with you over here. Let's say Euro New Zealand dollar. Okay, let's say the 4-hour time frame. You have a very nice bounce over here. At this point, right, many traders might be hesitant to buy this false break over here, right? Rayner, look how bearish this is. Look at the big bearish bad ass candles coming to support. Rayner, are you sure you want to buy? Now, if you just look at this chart on its own, right, it can be daunting to buy. But if you understand higher time frame price structure, things will change. Because if you look at the big picture at a daily time frame, okay, you realize that that level is a key level. Let me just split the chart so you can see what I mean, right? So this is the daily time frame that you've seen earlier, and this over here is the 4-hour time frame. So basically what has happened is that if you zoom out on a daily time frame, you can see that this is previous resistance that could act as support, and this portion over here, I'm just going to zoom in. This candle that you see over here is formed on this 4-hour time frame, this false break that occurred. So you can see that on the daily time frame, this is actually a key level. This is actually a daily level, not just a 4-hour level. Okay, and that will increase, right, the odds of your trade, especially when you lean against higher time frame support resistance. So this is what I mean by, higher time frame price structure confluence. This will really, put the odds in your favor. So as much as, sniper trading entries, I want to say that it's just memorizing a few chart patterns, but that isn't the case, because context matters, right? Are you trading with the trend? Are you trading from an area of value? Do you have the confluence of higher time frame support resistance? All this matters, not just some magic pattern that you just pluck out of thin air and find it on your chart. Okay, so a quick recap. Number one, the false break price pattern that we spoke about, right? Basically, profiting, or rather it's a reversal, right? Trading pattern. Number two, the breakout with the build up, right? Looking for consolidation before you buy a breakout. Number three, the break of structure, so you can enter the start of a new trend with low risk. Number four, the first pullback, right? So even if you miss the first wave of the move, don't worry, you can look for a first pullback to get on board the trade. And finally, right, context matters. Okay, so don't just focus on the pattern, right? Spend your time focusing on the context of the markets as well. So with that said, right, I've come to the end of today's training. I hope you've enjoyed it. If you do, smash the thumbs up button, subscribe to the channel, and I will talk to you soon.